Welcome to the Deep Dive. Today we are focusing our analytical lens on Nu Holdings, the undisputed king of Latin American fintech, trading under the ticker symbol NU.
Nice.
This company has not only captured the imagination of millions across Brazil, Mexico, and Colombia, but it's fundamentally rewritten the rules of banking across an entire continent.
And our mission today is to move beyond just that narrative of disruption. We've pulled together a really comprehensive stack of sources, an investment memo detailing history, financials, unit economics, all the risk factors through Q3 2025 to answer a single critical question for this serious long-term investor.
Which is?
Does Nu Holdings, which is now this massive multinational platform, still offer a compelling opportunity?
And the scale is just staggering. I mean, Nu Holdings is the world's largest digital banking platform outside of Asia, currently serving a truly monumental 127 million customers.
It's a huge number. We're talking about a company that achieved explosive, necessary scale in record time.
But what makes NuBank so uniquely compelling is this paradox that, frankly, very few high-growth fintechs ever resolve.
Right.
They didn't just scale rapidly, they achieved radical, sustainable profitability. Our sources confirm they hit a record 31% return on equity, or ROE, in Q3 2025.
And that number, that 31%, that places them squarely in the top decile of global established banks.
Let alone a decade-old disruptor.
Exactly.
So that's the central tension we need to analyze. How do you maintain that kind of hypergrowth while simultaneously achieving top-tier financial efficiency? I mean, usually you have to trade one for the other.
You do.
Okay, let's unpack this and start with how they even managed to launch this revolution in the first place.
The story really begins in São Paulo back in May 2013. It was founded by David Velez, Cristina Junqueira, and Adam Wiebel. And Velez, he's an outsider with significant experience at Goldman Sachs, Morgan Stanley, Sequoia Capital. He recognized that the Brazilian banking system wasn't just inefficient.
No, it was fundamentally broken.
It was broken, and that's the key.
The context of that problem is so essential here, because I think it explains the speed of Nu's adoption. What exactly was the structure of that banking oligopoly that created such widespread consumer pain?
It was an incredible case of entrenched power. The system was just dominated by 5 major players, and they had effectively divided up the market.
Right.
And they charged these truly exorbitant fees. Our sources detail over 120 different types of fees.
120, yeah.
Yeah. We're talking about nickel and diming customers for every single interaction, charging $1 just to check an ATM balance or, requiring fees for a simple SMS transaction notification.
Wow.
This systemic abuse meant that millions of people were left underbanked or had no access at all to formal credit or savings.
So the solution they launched in April 2014 was not just a product. It was a complete rejection of that status quo.
Absolutely. They launched the no annual fee Purple MasterCard credit card, managed 100% through a mobile app.
And that was the key. Mobile first.
Correct. The mobile-first zero-fee structure was completely groundbreaking. It immediately eliminated the massive overhead costs, no branches, no tellers, no legacy infrastructure that just saddled the incumbents.
And the name itself was a signal.
It was. The name Nu was part of the whole branding strategy. It translates to new in English, but also nude or transparent in Portuguese, which was a clear signal of their commitment to openness.
And the market just responded immediately to that transparency.
Within 2 years, they had 1 million customers. And that early success, it wasn't achieved through some massive marketing spend.
It was all word of mouth.
It was almost entirely organic virality, word of mouth fueled by customer satisfaction. That early data point, 1 million customers between 2013 and 2015, that provides the very first clue about their eventual $7 customer acquisition cost. The product was just so much better, it basically sold itself.
Okay, so once the credit card proved the concept, they began the strategic expansion. What was the pivotal moment that really differentiated them from just being a cool credit card company?
That had to be the 2017 launch of the Nu account.
The digital checking account.
Yes, this was a free digital checking account offering fee-free transfers and, critically, automatic interest on balances. This shifted the customer relationship from something transactional like a credit card to something foundational.
This is where you keep your money.
Exactly, where you keep your money and manage your daily finances. It dramatically increased customer stickiness, and it also provided Nu with valuable deposit capital, which, is the fuel for their lending operations.
And once they mastered Brazil, the next critical step was proving the model's portability.
Mhm.
Could it work somewhere else?
And they executed that geographic playbook perfectly. They entered Mexico in 2019 and then Colombia in 2020.
And that was a huge deal.
It was a significant achievement because it demonstrated that the underlying principles, low cost, transparency, digital experience, weren't just unique to the Brazilian environment.
Right. It was a repeatable model.
It was. They could apply the same strategy. Start with a simple, high-value product, build trust, and then cross-sell the full ecosystem. We should also mention their acquisition strategy was surgical.
Not just buying up revenue.
No, not at all. Acquiring Easy Invest for investment capabilities and Olivia AI for intelligence, it was focused on talent and capability rather than just buying revenue streams.
And that path of disciplined growth led them right to the NYSE IPO in December 2021, raising $2.6 billion and positioning them as the largest digital bank globally by market cap at the time.
But this is where management quality was really stress tested. The market turned hostile almost immediately after they went public.
Oh yeah, the 2022-2023 bear market was just brutal for high-growth tech valuations. News stock dropped, what was it, 67% from its highs?
It did, and this is often the moment when management teams make really short-sighted decisions. They panic.
But they did the opposite, right? They maintained that growth discipline while pivoting to core profitability.
They pivoted decisively. They maintained a highly disciplined 22% annual customer growth rate during that downturn, focusing on high-value customers, not just, growth at all costs. And this shift culminated in achieving their first quarterly profit in Q2 2023.
So that bear market resilience proved the business model had enough operating leverage and pricing power to sustain profitability, even under immense pressure.
It did. And that pivot leads us directly to the quality of the leadership, specifically the CEO, David Velez. The investment memo highlighted one of the most remarkable anecdotes about management integrity I have ever seen.
This is the compensation story. It's incredible.
The November 2022 compensation decision is truly exceptional. David Velez voluntarily terminated his 2021 contingent share award. This was a variable compensation package that, based on performance metrics, was potentially worth north of $800 million.
$800 million. He just walked away from it. Why?
His stated rationale was that his existing 20+% ownership stake provided more than sufficient alignment with shareholders. He felt a compensation package of that magnitude was unnecessary and could potentially send the wrong signal.
And he did this while the stock was under severe pressure.
Exactly. That action sends an undeniable signal of integrity and long-term commitment. He was prioritizing shareholder confidence over personal enrichment.
And beyond that integrity, the operational discipline is also evident in how they manage scale. Can you talk a bit about the 2025 organizational restructuring?
Sure. As companies scale to 127 million customers, they often become slow, bureaucratic. It's almost inevitable.
Right.
So the 2025 organizational restructuring was a deliberate move to counteract this. They flattened the entire management structure, cutting the layers from 14 down to 7.
Wow, half.
Half. And this aims to drastically improve efficiency, accelerate decision-making, and ensure the company maintains its high-velocity execution culture, which is just vital as they expand into more complex product lines.
So Velez is clearly focused not just on the immediate quarter, but on the long game.
Absolutely. His strategic vision operates on a clear 5 to 10-year horizon. He's executing this 3-act strategy. First, achieve deep LATAM market dominance. Second, vertically expand into every possible financial product line. And third, eventually, global entry.
Then we see the proof in the metrics.
We do. Maintaining an active customer rate above 83% globally and achieving that structurally superior 28% efficiency ratio.
So this historical arc, it provides 3 critical lessons. 1, the repeatability of the playbook across 3 distinct countries, proving that the disruption model isn't just a one-off.
Right.
2, the achievement of over 30% ROE, proving fintech scalability and, sustainability.
And finally, the exceptional shareholder-aligned quality of the management team. This is a platform that's really built for the long haul.
Exactly. So now we can transition from the history of disruption to the anatomy of their current dominance. We need to dissect the business model that sustains this level of profitability and growth, and critically, how they built these unassailable moats. So the core of the business model is what they call land and expand. They acquire the customer cheaply. We know that CAC was around $7, and then they cross-sell them into this fully vertically integrated product suite.
And that vertical integration is absolutely key to maximizing lifetime value, or LTV. They start with the spending products. the no-fee card, the premium ultraviolet card, and leveraging Pix for instant payments in Brazil.
Then they move to savings.
Right, then they anchor savings with the new personal and business accounts. The third vertical is investing, which they do through New Invest, New Crypto, and their goal-based money boxes feature.
And finally, you get to the big revenue engines, borrowing and protection.
Correct. Borrowing includes personal loans, payroll loans, and Pix financing options. And protection, which is new insurance, covers life, mobile, auto, and home. So the revenue model is highly diversified now. It's shifting away from just those low-margin interchange fees to rapidly scaling net interest income from the credit products, and then the high-margin fee income from insurance and subscriptions.
We see these varied levels of maturity in their markets. Brazil is the engine, obviously, but the runway is still enormous in the rest of Latin America.
Right. Brazil is in what you call mature growth. They have about 60% adult population penetration, which is huge.
But still has room.
But it still has room. Mexico, however, with 13 million customers, is in high growth at only 14% penetration. And then you have Colombia with 4 million customers, which is in early growth. This staggering difference means they are not dependent on a single market for their future growth.
Let's try to size that opportunity. The combined adult population of their three core markets, Brazil, Mexico, and Colombia, is roughly 290 million people. And that historical underbanking, that's the fertile ground.
It is. The total Latin American fintech market is valued at $300 billion in 2024, and it's projected to grow at a healthy 12 to 18% CAGR. Nu's immediate strategic opportunities, what you might call the serviceable obtainable market, or SOM, they focus on adding depth and breadth.
So talk to us about the depth in Brazil, specifically regarding secured lending.
Even in their most mature market, they only have 15% credit card market share. So there's clear room to double that towards 30%. But you're right, the most strategically significant opportunity is the Brazilian payroll loan market.
And for the listener, this is where payments are deducted directly from someone's salary, right?
Exactly, which makes it a secured, significantly lower risk and higher margin product. News is targeting 10% market share in this segment by 2026. This move is crucial not just for revenue, but for dramatically improving the overall credit quality and margin profile of their entire lending portfolio.
And what about that geographic breadth? Is the competitive landscape in Mexico and Colombia as complacent as Brazil was a decade ago?
That's a key question, and the answer is a bit mixed, but still favorable. In Mexico, while the banking system isn't quite as sclerotic as Brazil's original oligopoly, underbanking is still rampant, and the incumbents still rely on high fees and really poor digital experiences.
So the playbook works.
It does. Nu, trading as New Mexico, is already the largest issuer of new credit cards in the market. They've achieved 14% penetration in a very short time. So the goal is to scale Mexico from that 14% to 25-30% penetration by 2027. The model's repeatability is confirmed by just how fast they're acquiring customers in these new markets.
Okay, this brings us to the core reason why Nu is a world-class opportunity. The competitive moat. You identified 5 sources, but let's start with the one that underpins their entire structural advantage.
The cost advantage is, without a doubt, their strongest moat. The single most important figure in the entire investment memo, and one we really have to understand fully, is the 80-cent cost to serve per active customer per month.
80 cents. How does that compare to the incumbents?
It's night and day. Traditional Brazilian banks, which are burdened by massive branch networks, legacy IT systems, high employee costs, they typically spend between $8 and $9 per active customer per month.
So Nu is operating at 1/11th the cost.
1/11th. And this isn't a temporary discount. This is a permanent structural advantage.
But how is such a drastic cost difference even sustainable? What is the technology that's driving that 80-cent number?
It's a combination of things. They're 100% cloud native. They built a proprietary API-driven technology stack in-house. And critically, they leverage AI automation across nearly every single process.
While the incumbents are stuck.
They're stuck spending billions ripping out old mainframe systems and digitizing paper-based processes. Nu just started digital from day one. Their credit models, their customer service, which is often handled by AI chatbots, not human agents, and their fraud detection are all run on proprietary LLM-backed systems. This means that as they scale, their cost per customer actually decreases further, creating this unparalleled operating leverage.
So their technology isn't just a differentiator. It's the engine that guarantees their superior profitability compared to basically any traditional bank. What about the other moats?
Second, you have network effects and virality, which are very strong. Remember, 80 to 90% of their growth is organic.
Referrals.
Referrals. Every satisfied customer is a free marketing channel. This self-reinforcing growth loop is why their CAC remains fixed at that low $7 figure, even as they add millions of new users every quarter.
That low CAC is essentially a subsidized growth rate.
Exactly. Third, brand loyalty and trust are strong. By building a trusted brand in a region that was defined by high-fee exploitation, the purple card has become a kind of status symbol for financial empowerment in Brazil. They consistently maintain high net promoter scores and that 83% plus activity rate, which translates directly into lower churn and eventually greater pricing power.
And switching costs.
They're moderate, but they are accelerating. As customers use Nu for direct deposits, for payroll, bill payments, and investing, they become deeply integrated into the Nu ecosystem. The fact that 45% of active customers now use multiple products confirms the stickiness is rapidly growing. It makes a move to a competitor increasingly costly and just inconvenient.
And finally, the emerging moat. Data and AI.
Right. With 127 million customers, they possess these vast, unique data sets on Latin American credit behavior, spending habits, payment preferences. And the June 2024 acquisition of Hyperplane, which is a Silicon Valley firm specializing in large language models for finance, that solidifies their AI-first strategy.
And this isn't just about faster customer service.
Not at all. It's about micro-level credit personalization and fraud detection that outpaces human-driven models, which then feeds directly back into improving their risk-adjusted margins.
Okay, so here's where it gets really interesting for me. That 80-cent cost to serve is not just a footnote. It's the foundation upon which this entire investment thesis rests. That staggering operating leverage is the reason these world-class financial numbers we're about to explore are not a fluke, but are structurally engineered.
So moving to the hard financials, Nu's unit economics are, they're virtually unmatched globally, particularly in the fintech space.
We know the CAC is $7, but the lifetime value, the LTV, that's what defines their financial power. The reported LTV to CAC ratio is greater than 30 to 1.
That 30x plus figure is just extraordinary. For context, best-in-class SaaS companies, they're aiming for 3x. U.S. neobanks are generally struggling to prove sustainability in the 5 to 12x range.
So 30 is just off the charts.
It is. A 30x ratio reflects the massive margin differential created by that 80-cent cost moat, combined with the rapid cross-sell adoption.
But I have to ask a critical question here. Is that 30x LTV CAC figure based solely on the mature, high monetization Brazilian market, or does it include the newer, lower ARPAC markets of Mexico and Colombia?
That's a necessary challenge, and the LTV calculation does heavily rely on the high-value Brazilian customer cohorts, especially those who've been active for, say, 3 to 5 years and are now adopting high-margin products like insurance and payroll loans.
Okay.
However, the sheer volume of low-cost acquisition in Mexico and Colombia means that even if the LTV is temporarily lower there, the payback period remains extremely short, often under 12 months. So that 30x figure acts as the proven ceiling for mature customers, which guarantees future value realization as the new geographies mature.
And we're seeing that value realization already.
Yeah.
Monthly average revenue per active customer, or APAC, reached $13 in Q3 2025. That's an 18% increase year over year.
And that growth demonstrates the successful execution of the expand phase of their model. Cross-product adoption jumped from 37% to 45% year over year. But again, look at the potential here.
Right.
55% of their 127 million customers remain single-product users. That is arguably the largest untapped revenue opportunity in global banking today.
It's massive.
If they can convert just another 10-15% of those single-product users to 2 or more products, ARPAC will accelerate dramatically, pushing that LTV metric even higher.
Okay, let's talk about the overall profitability metrics from Q3 2025. These are truly world-class numbers.
Total revenue hit $4.17 billion. That's up 39% year over year on an FX-neutral basis. Net income was $783 million, matching that 39% growth.
And the key metric of efficiency, the efficiency ratio, stood at 28%.
We need to pause on that 28%. It means they spend only 28 cents to generate $1 of revenue. Their traditional bank peers are spending 50 cents or more. This is the structural proof of the cost moat we just discussed.
And the crowning achievement, return on equity, or ROE, hitting 31%.
Achieving 31% ROE confirms their status as a capital-efficient powerhouse. This isn't startup growth anymore. This is mature, proven, high-quality capital generation, placing them among the most profitable banks in the entire world. The gross profit margin is also really robust at 43.5%.
Let's transition to the margins, particularly as they increase their lending exposure. Net interest margin, or MIM, was 17.3%. However, we did note a slight sequential dip. Why was that, and should investors be concerned?
That small dip was strategic. It wasn't systemic. It was attributed to deliberate strategic deposit pricing as they rapidly scale up operations in Mexico and Colombia.
So they're investing in growth.
Exactly. To attract those early customers in the new markets and anchor the banking relationship, they offer slightly more attractive savings rates, which temporarily compresses the overall NIM. It's an investment in future customer stickiness.
But the critical indicator that should reassure investors about the quality of their lending is the risk-adjusted IM.
Exactly. This is the metric that matters most for a high-growth lender. The risk-adjusted NIM expanded by 70 basis points year over year to 9.9%.
And for the listener who might not track this daily, we need to stress why this is so important.
Right, so NIM is your gross lending profit. Risk-adjusted NIM calculates that profit after you deduct your expected credit losses.
So if your overall credit portfolio is growing at 42%, but your risk-adjusted NIM is actually expanding,
it means your proprietary underwriting models are working exceptionally well. They are growing the volume of loans without allowing the underlying risk profile to consume the increased margins. This 9.9% figure is the definitive proof that their AI advantage is functioning to counter generalized credit concern.
Okay, finally, let's look at capital generation. We noted a wide variance in the return on invested capital, or ROIC estimates, from 5.5% all the way up to 17.4%. Why is that variance so wide, and what does it tell us about shareholder value?
The variance stems from different methodologies that analysts use in calculating the denominator, the invested capital, particularly in how they account for intangible assets like technology investment.
Okay.
However, regardless of which model you use, the key finding is unanimous. All the ROIC estimates are firmly above their estimated weighted average cost of capital, or WACC, which is typically modeled between 11% and 13%.
Which means they're creating value with every single dollar they reinvest.
Precisely. When your ROIC exceeds your WACC, the business is generating a positive economic spread. New isn't just growing, it's growing profitability in a capital-efficient manner, generating long-term shareholder value. The business model is a value creation engine.
Financial results confirm they are growing fast, efficiently, and profitably. But that 42% credit volume growth, combined with the emerging market exposure, mandates a deep dive into how they manage risk, especially given the macroeconomic environment in Brazil.
Okay, let's tackle risk head-on. The credit portfolio grew massively year over year to $30.4 billion in Q3 2025. And in the context of Latin America, credit risk is paramount.
Right. So the 90-plus day non-performing loan ratio, or NPL, sits between 7.0% and 7.2%. How should we contextualize that figure? I mean, is it alarming?
It requires some careful context. Compared to U.S. neobanks or, mature U.S. traditional banks, which might target NPLs in the 3-5% range, yes, 7.0 to 7.2% looks elevated.
It seems high.
It does seem high, absolutely. However, this is absolutely reflective of the inherent risk profile of unsecured lending in emerging markets like Brazil, where economic volatility is higher and credit history data is less mature.
So you have to compare it to local peers.
Exactly. Many traditional Brazilian banks have similar or only slightly better NPL ratios, yet their cost structures are significantly higher. New's superior operating leverage and underwriting allows them to absorb a higher NPL ratio while still achieving that 31% ROE.
So the NPL is the cost of doing business in Latin America, but they are minimizing the impact through their efficiency. How are they actively improving the quality of that $30 billion portfolio?
The strategic shift to secured lending is the answer. Our sources detail a massive 133% year-over-year growth in secured lending, primarily payroll and asset-backed loans. This is their crucial mitigation strategy. Secured loans, because the collateral or the payment stream is guaranteed, like a salary deduction, they carry far lower risk.
Why is a 133% shift in secured lending so significant for the whole investment thesis?
It fundamentally de-risks the portfolio's growth trajectory. By tilting the mix towards secured assets, they lower the probability of catastrophic credit deterioration even during a macroeconomic downturn. It stabilizes the portfolio quality, allowing them to grow lending volume sustainably while also improving the margin profile of those loans because they're higher margin products.
Any leading indicators that this is working?
Yes, the sequential improvement in the 15 to 90-day NPL ratio, which is sitting between 4.1% and 4.5%, that's the leading indicator that reflects this improved discipline.
Okay, now let's address the geographic concentration risk. 82% of revenue still comes from Brazil.
And this is their primary structural risk. They are highly leveraged to Brazilian macroeconomic volatility, high inflation, elevated interest rates, and currency fluctuation. While the company reports numbers FX neutral for analysis, a severe devaluation of the real or a prolonged recession will disproportionately impact their local purchasing power and deposit base.
And Brazil's tax structure adds another headwind to that.
It does. Brazil's statutory corporate tax rate is a high 40%, which creates an artificial disadvantage compared to companies operating in lower tax jurisdictions. However, again, we loop right back to the cost mode.
The efficiency ratio.
Right. That high tax burden is partially, if not entirely, offset by their 28% efficiency ratio. They are so much more efficient at the operational level that they can survive a high tax rate while remaining globally competitive on profitability.
We have to discuss the governance aspect, specifically the Warren Buffett exit. His firm, Berkshire Hathaway, fully exited its position in Nu sometime in 2024-2025. For many investors, that sends a massive red flag. Why should a long-term investor not panic over the Buffett exit?
We have to analyze the context of the sale, not just the sale itself. Buffett's mandate is notoriously focused on massive, mature, domestic U.S. assets. His firm has been systematically pruning smaller, international, or higher growth positions that don't fit that large cap, low volatility profile.
And the timing is key.
The timing is critical. The exit happened during a period of record profitability for Nu, when they were achieving that 31% ROE and proving the long-term unit economics.
So it's more likely a strategic portfolio rebalancing for Berkshire rather than a fundamental loss of confidence in the underlying business.
Exactly. If Buffett had exited when the stock was collapsing 67% in 2022, that would have been a strong fundamental signal. Exiting when the company is hitting record efficiency and profitability suggests a mandate constraint or a liquidity need, not a fundamental flaw in the newer business model. We can't ignore it, but we shouldn't allow it to overshadow the objective financial evidence.
Let's pivot to the growth levers. The future of Nu is clearly linked to its AI-first strategy, which was solidified by that Hyperplane acquisition.
The Hyperplane acquisition in June 2024 was a major statement. Nu is moving beyond just using AI for basic underwriting and detection. They're aiming for next-generation platform capabilities. This is about leveraging LLMs to create hyper-personalized financial products, anticipate customer needs, and automate complex compliance and operational tasks. This investment is crucial for maintaining their cost moat and their data advantage as they continue to scale.
And the most ambitious strategic optionality is a potential for global entry, specifically via the U.S. market. They applied for a U.S. national bank charter in September 2025.
This move signals extraordinary ambition. It places the entire $20 trillion U.S. addressable market on their long-term map. Strategically, this is comparable to their initial entry into Mexico. If they get approved, the potential upside is just enormous.
But the execution risk increases significantly. I mean, the U.S. market is not Latin America.
It's a vastly different beast. They won't be disrupting a complacent oligopoly. They will be competing against highly sophisticated, well-funded incumbents and aggressive neobanks like SoFi. The regulatory environment in the U.S. is intensely complex, navigating capital requirements, deposit insurance, consumer protection laws. Nu's ability to maintain its low-cost model and cultural cachet in a mature market with deeply entrenched competition. That will be the ultimate test to Velez's vision.
We've established the moats, the financial resilience, the risk mitigation strategies, and the forward-looking optionality. So now we bring it all home. How does a 33x trailing PE ratio, which seems high for a financial institution, stack up against this explosive, profitable growth? Is the stock still cheap?
When analysts first look at Nu holdings, the initial reaction is almost always sticker shock. Trading at 30 to 34 times trailing 12-month PE and 12 to 13 times price to sales, it suggests a highly expensive bank stock.
But in the world of high growth, proven profitability, focusing on TTM multiples is fundamentally misleading.
It is entirely misleading. We have to focus on the forward view. The consensus projection for 2025 earnings per share, or EPS, growth is a robust 36%. And when you factor in that anticipated growth, the forward PE ratio drops significantly into the attractive 20 to 23 times range.
But why should we believe that 36% EPS growth is sustainable, especially since Brazil is becoming a mature market for them?
That sustainability is driven by three factors. First, the massive AR-Pack expansion potential as they cross-sell to that 55% of single product users in Brazil.
Right.
Second, the massive operating leverage derived from that 80-cent cost base, meaning revenue growth, drops almost directly to the bottom line. And third, the non-overlapping accelerated growth from the younger markets of Mexico and Colombia. The growth is diversified by both product depth and geographic breadth. That 36% figure is fundamentally supported by the structural advantages we've been talking about.
And the key metric that synthesizes all of this data is the PEG ratio.
The PEG ratio, price to earnings to growth, is the final piece of the valuation puzzle. Nu's PEG ratio is currently estimated between 0.22 and 0.40. This is the clearest indication that the stock is undervalued relative to its exceptional growth rate.
And just for context for the listener.
Right, a PEG ratio below 1.0 is generally considered attractive. Anything below 0.5 suggests significant mispricing relative to future growth potential.
Okay, let's compare Nu's multiples to its peers. How does a 20 to 23 times forward PE look against local and international competitors?
It justifies a substantial premium. Nu trades at a premium to mature Brazilian banks, which often sit at 8 to 12 times PE, with ROEs of maybe 15% to 20%. Nu's premium is justified because they are delivering nearly triple the ROE at 31% and significantly higher growth.
And against other neobanks.
Compared to U.S. neobanks like SoFi, which trades closer to 15 to 20 times forward PE, Nu's combination of 40% plus revenue growth and world-class 31% ROE just sets it apart. The market is paying a premium for quality and execution, and the PEG ratio suggests that premium is still too low.
So synthesizing everything from management integrity to those incredible unit economics, what is the final assessment for the long-term investor?
The consensus analyst price targets suggest only modest near-term upside, but our analysis points toward a significantly larger long-term opportunity over the next 3 to 5 years, assuming strategic execution remains consistent.
Is Nu investable today?
Yes, I'd say highly investable, but it requires the investor to have a long-term time horizon and a realistic comfort level with emerging market volatility.
It's not for the faint of heart.
Not at all. The investment thesis relies on three pillars: best-in-class unit economics, that 80-cent cost to serve, and the 30x plus LTV CAC. 2, proving sustainable profitability with that 31% ROE. And 3, exceptional shareholder-aligned management. The valuation, on a growth-adjusted basis, that PEG of 0.22 to 0.40, confirms the opportunity.
And the reasons for caution must be top of mind.
Absolutely. Caution is essential. First, the 82% revenue concentration in Brazil remains a vulnerability to currency and political shocks. Second, the elevated 7.0 to 7.2% NPL ratio, while being mitigated by that massive shift to secured lending, must be constantly tracked. And finally, the large, untested execution risk associated with global expansion, specifically the U.S. bank charter application. That is the swing factor for their next decade.
Given the fundamentals and the execution track record, where does that leave us?
Our final assessment is a strong buy for long-term investors with emerging market risk tolerance. This is a platform that has demonstrated an unassailable structural advantage in one of the world's most dynamic financial markets. So to summarize the critical takeaways from this deep dive. First, Nu possesses best-in-class structural unit economics anchored by that 30x plus LTV CAC ratio and the 80-cent cost-to-serve moat, which is just unparalleled in global finance.
Right.
Second, they have proven scalable profitability, achieving a record-high 31% return on equity, which confirms the model's sustainability. And third, the management quality is exceptional and demonstrably shareholder-aligned, evidenced by David Velas's voluntary termination of over $800 million in contingent compensation.
It's an incredible confluence of factors.
Yeah.
High growth, superior efficiency, and disciplined leadership. Nu has demonstrated it can not only navigate but thrive amidst the endemic risk of operating in Brazil, leveraging its technology and scale to capitalize on that volatility.
But the story is evolving beyond Latin America. The domestic challenge has been met. The global challenge is on the horizon.
And that leads to our final provocative thought for you, the listener. Nu mastered disrupting a complacent oligopoly in Latin America by focusing on cost and transparency. But if the U.S. bank charter is approved, How will Nu's low-cost, digital-first model translate against the vastly different competitive environment of the U.S.,
It's a huge question.
where capital requirements are stricter, marketing is more expensive, and the market is saturated with sophisticated incumbents? Will their structural cost advantage be enough to win in a market where they have absolutely no brand recognition?
A fascinating test for a truly world-class company's next chapter.
Food for thought indeed.
Hmm.
Thank you for joining us for this deep dive into Nu Holdings. We'll see you next time.